Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in this technical analysis video, we're gonna take a look at a stock which is ready to give a 30-40% kind of move even in this weak market from the positional trading perspective. So we're gonna analyze first the monthly chart, weekly and the daily chart why and figure out why it is ready to give a 30-40% kind of a move. Before going right into the video, standard disclaimer, I'm not a SEBI registered analyst and any stock discussed here is not a buy or sell recommendation. Please consult your financial advisor before taking any trade or investment. So let's get started with the video, and the stock we're going to discuss today is Alkan Engineering. So this is the monthly chart. As you can see, it made a high of around 343 rupees back in December 2007, and after that it fell sharply. As you can see here, uh, it almost fell 93% after a very good up move from around 66 rupees to it went to 343 rupees and then fell 93% to 26 rupees, and after that it has been trading in a broader range since 2008, and it made a low of rupees 16 in March 2020 fall, the COVID fall. So why it is ready for a nice up move in next few days? First we're gonna take a look at that. Before that, on the monthly chart, as you can see, we're gonna establish a broader range. As you can see, from around August 2008 to the present, back in May to 2021, it was facing resistance around 100 to 120 rupees, and again uh, every time it reached this level. As you can see, every time it reached this level of 100 120, it fell again, and this time it finally crossed this level. As you can see, uh, it finally crossed this level. So this was our trading range. As you can see, this was the broader range from 100 to 120. It finally crossed this range in back in May 2021. So let's go down to weekly chart. As you can see, this was our range, and it gave a very nice breakout. As you can see here, uh, very nice bullish candle, follow-up candle, and look at the volumes. Look at the volumes, very high volume in the up move. So if we come down to daily time frame, uh, it was trading in a range. As you can see, from back in August to 2021, it was trading in a range, a broad range. We can establish a range here. It was trading in a range of rupees 183 to 146, around 40 rupees kind of range, and it has given a breakout today, a very nice breakout. As you can see here, this candle, a very nice breakout combined with huge volume, a huge volume jump. As you can see, while it was in a consolidation phase, volumes were muted, and as it broke out, look at these two candles. As it broke out, look at the volume activity. Volume also picked up. So this was a range. This is a concept. This concept is also known as Darvas box theory. So Nicholas Darvas, back in 1950s, was a trader who developed this theory, and according to this theory, Darvas trading technique involves buying into stock that are at new highs and drawing a box around the recent highs and the lows to establish a entry point and a placement of stop loss order. So what it's basically telling, a stock crossing new high, which is this. As you can see here, the stock is exactly, this was our range, sorry, so this was our range around 183 rupees, and it crossed this range today, and it fell down and again went up, fell down again went up. So it formed kind of a box. As you can see here, from this point it made a high back in August 2021, and after that it went into consolidation and made a box. and now it's giving a breakout. So this theory basically tells that the trader Nicholas Darvas developed a theory buying a stock with good momentum and good volume. As you can see, it satisfies both the criteria: good volume, wide range candle, and the box. And his theory was simple: whenever a stock breaks the box on the upside, you will buy, and you will keep the low of the box as your stop loss, and you will uh, keep holding that stock with the trailing stop loss. For example, if it goes like this, you will shift your stop loss to this level and then to upper level, and if it's again start consolidating, uh, you will again follow the same process. If it start consolidating and forming boss, you will again buy if it crosses the upper end of the box, and keep the lower end as the stop loss. So this is the simple uh, Darvas box theory which we're gonna follow in this talk. uh, One thing also adds conviction: that see this candle here, these two candles, stock broke the lower end of the box. As you can see here, stock broke the lower end of the box, but it didn't follow up on that next day. As you can see here, it broke the lower end of the box, and next day a big wide range candle, it reversed from there, and now it's giving a breakout. So it's a very good sign. It signifies that strong is in sorry, the stock is in strong hands, meaning the big players are entering in the stock. So how did I figure out that it can give a 30-40% move? For that, we're gonna go back to the monthly chart. So first target point would be the all-time high level, that is around 343 rupees. As you can see, very strong the stock has very strong momentum. As you can see, no negative candle on monthly chart, and look at the huge volume up move. So, and it also broke this range that we had established, this range of 100 to 120 rupees. It also broke this range with huge volumes, as you can see here. So this would be our target point, and it is around, if we calculate from the top of the box, around 80% away from the current price. And second thing we can use to arrive at the target prices, uh, wait a second, we can use the Fibonacci. If we apply the Fibonacci from the top of this rectangle and the bottom of this rectangle, as you can see, these are our target prices that we have arrived. So our first target would be 213 rupees, second target would be 256, third would be 300, and fourth would be 327. So these are our target prices. And as for the stop loss, so according to Darvas theory, this point that is around 140 rupees should be our stop loss. But given the whole market, given the weakness in whole market, we shouldn't I don't want to take much risk, so I would use this candle's low, which is around 164.65 rupees. We can use the 164 as stop loss, and 213 would be our first target, and 256 would be our second target, because the whole market is weak from past few weeks, and today also Nifty fell almost 2.5 to 3%. So taking much risk on the longer side is not advisable at this point. So we're gonna use a tight stop loss, and this would be our target prices. So this was it for today's video. I hope you learned something, and if you enjoyed the video and learned something, please consider hitting the like button, and don't forget to subscribe and share, and take care.